This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, getting into the week, getting into the thick of things. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Morning,
Hi,
Nigel.
morning.
Well, looks like we have some ammunition today for the Bulls, right? HDFC Bank's numbers not bad, guidance is good. Even the global markets were not too bad.
Well, that's right. You know, HDFC Bank, that's going to be the key stock from here. Will it stop underperforming from here? I think that's the key question, right? Outperformance, I think that's secondary. But will it stop underperforming is going to be important. And otherwise, things were looking good. But only that Biden visit tomorrow. So I think the markets will wait to watch out for what happens on that front.
We were saying this yesterday, right? At the margin, I mean, it's such a twisted, complex situation, but at the margin, the fact that the US is getting involved diplomatically to try and contain the conflicts from spiraling out of control is perhaps a little bit positive, because the risk is that, I mean, other countries get involved and it becomes a bit of a proxy fight. So in that sense, I think it is positive, and it was showing through in yields, etc. yesterday overnight. Well, let's just quickly tell you what you need to know as we start another sort of trading session. We'll begin where we left off yesterday. Yesterday was absolutely flat. I mean, and it got flatter by the time we actually ended. Even the mid and small cap part of the market, which was up 0.25%, 0.75%, I mean, they had very little left to show by 3:30. On the index, of course, nothing at all. But overnight, the environment is risk on, right? I mean, US indices have done well, and not just the S&P, the Nasdaq is up. That's been the one which has been under pressure. But you also have the small cap index, which is extremely under pressure. The Russell 2000, which went up actually even more, 1.5% plus. Yields have rebounded, right? Now, you have to look at what yields are doing, and higher interest rates mean a certain set of outcomes. Lower market interest rates mean a certain other set of outcome. The driving force for yields to actually sell off, and we said this yesterday, that yields last week, Friday to Friday, were down almost 20 basis points. The narrative has been about what the Fed itself is saying, that market rates have gone up so much that they don't need to do very much in terms of interest rates. So it's that. But this also very clearly demonstrates risk sentiment, right? Bond prices coming off, yields going up. And that basically is a risk-on environment. And that largely at the margin over the last couple of days has also started to be influenced by geopolitics. Dollar index, that's the other one, right? I mean, money going into the dollar is risk aversion. Of course, it can mean other things as well. But for now, that's essentially, how this is looking. And dollar coming down is maybe a little bit at the margin. People becoming a little more comfortable taking on some risk, especially in things like equities, etc. Oil prices, they're still holding a tad above the $90 a barrel mark. So not very much by a change there. It was down slightly, but still above 90. Now, how does all of this tie into the market here? The Nifty is still above the 20-day moving average, but by only a whisker. 17,716 is the 20-day moving average. We left off about 15, 16 points above that particular level. So that's got to be defended. First up, no question about that. The rising trend line from the bottom now is near about 19,710. Again, around the 20-day moving average. So hopefully there's a cluster of support, if the need be, that's going to be supported. But the big one is the 40-day exponential moving average, which is a little lower. Again, not very far away, but that's 19,640. And that's a support which should not be broken if, this market eventually, after all of this confusion and up and down and not very much by way of actual price move to show for it, has to resolve higher. So that's the level which should not be broken on the downside. Nifty Bank did not close positive. It failed to confirm a higher low in trade yesterday. And the Nifty Bank has been clearly the weaker. It's actually lagging behind the Nifty in a very, very substantial way. And hopefully it'll pick up. So far, it's not. Now, the Nifty Bank needs to first cross the 20-day moving average, which stands at 44,714. Again, not very far away from where we are, about 1% or so. On the downside, it should not break levels of 44,044 and 43,900. 44,400 is low. Yesterday's low. 43,900 is the recent low around where the market has found support. So these are levels to work with. Hopefully, and I said this yesterday as well, things at the margin looking a little more constructive. So let's watch this space. the intensity of market reaction to known events also starts to fade. And we've seen this over and over and over time the intensity the market does not react in a very, very sharp, vicious way to the second or the third time to the same event as compared to when it's a surprise. So that's the other thing to watch out for. 64 points higher. Hopefully, we're able to build on that with those levels in mind. I think I would say perhaps in a very small way, you can dip your feet in, see what prices want to do from here. Sonia.
Oh, absolutely. There is a lot of ammunition today for the bulls. So, in that context, it's going to be a good start, and perhaps we could even build on to our gains because, as I said, the bulls have a lot of ammunition. Let's start first with the biggest cue, right? HDFC Bank. And I liked what I saw with HDFC Bank's numbers yesterday. There was a rebound in terms of loan growth. The asset quality was steady. The guidance from the management was quite bullish as well. Post the merger, the pro forma loan growth was about 5% quarter on quarter. Sequentially, it's a 5% loan growth compared to a 1% loan growth that we saw in the preceding quarter. So in that context, loan growth has picked up. The company said that the bank is poised to deliver strong growth going ahead. They will maintain the ROA between 1.9 to 2.1% levels. And remember, we went into the earnings with very low expectations. There's been a big underperformance in the stock as well. So that will be the driving force of the market this morning, in all likelihood. The other thing to watch is Bajaj Finance. The earnings today will be closely watched out for. So that's another heavyweight that the street will keep their eye on. But apart from that, the Nifty will not only get support from HDFC Bank today, it will also get support from global cues. The Dow was up over 300 points overnight. There was also large buying from domestic institutions in our own market. So DI has bought about 1,200 crores in the cash markets, while FI sold less than about 600 odd crores. As I said, the US markets ended with very good gains. So that's another thing the bulls will latch on to. A lot of big numbers coming out later today. There's Bank of America, Goldman Sachs that will be reporting their numbers. There's retail sales, industrial production data for September that comes out today as well. The only thing on the margin you'd want to watch out for is what's happening with the currency, because yesterday the rupee hit a new low. It hit 83.28 because of crude fears, geopolitical tensions, etc. So just watch out for what's happening with the currency. Otherwise, the equity markets have actually been stable. The market has been building on to its gains, and this morning, definitely, there is some ammunition for the bulls.
Well, that's right. The GIFT Nifty is suggesting that we're likely to see a 60-70 point gap up, but we need to build on to those gains because that's what could lead to a big short covering bounce as well. So the 70-point gap up, it's encouraging, but building on to that is going to be something that the bulls will track. HDFC Bank, year to date, that's been a bit of an underperformer. Going by the numbers, going by the commentary as well, can it give up its underperformance? That's going to be important. And I think it has the ingredients out there because year to date, it's underperformed by more than 15%. And now with these numbers, you'll at least expect it to be a market performer, if not an outperformer. So HDFC Bank will bat for the bulls, and overnight as well, the ADR was higher. So that's what supports its case. The Nifty Financial Services Index, well, that plays out expiry. So that's going to be another moving part for the second half of trade. Just a quick point on cash market volumes yesterday. They were extremely tepid. If you're looking at the gross volumes from both FIs and DIs, well, they were 20 to 25% lower in comparison to the average that we've seen in October itself. So that's one data point. The other factor is the Nifty 50 stocks, the traded volume out there was less than 15,000 crores. The last time we saw such low volumes on the Nifty 50 stocks was near New Year, Jan 2nd, Jan 3rd. So that's telling you the kind of volumes that you had, extremely tepid volumes. Participation was extremely low yesterday. So I'd like to see more for recovery today in terms of participation, particularly on the Nifty 50 stocks. Positioning, well, the FIs, they lightened positions both on the long as well as on the short side. And now 73% of their positions are on the short side. Moving to the options data. Now the 19,750 call and the 19,800 call, you punch in those premiums out there. The 19,830, 19,850, that's the resistance zone for me. And on the downside, there was some writing being seen at around 19,700 put, which brings us to the levels. 20 and 50 DMA, important support zones. Near term, 20 DMA is important. On the upside, we went nearly to 19,850 and we did a U-turn from there. So that's important. And the Nifty Financial Services Index, well, that's the one that plays out expiry today. It's trading pat in line, in the middle of both those two strikes that have come up for you on the screen at around that 19,800. So the broad range should come up for you around a 250-point range. It's likely to expire in this particular range. Unless it breaks, either which ways, either higher or lower, then we could see a bigger move. So the GIFT Nifty suggests a gap up. HDFC stock, That's the one, HDFC Bank. That's the one that the bulls are banking on. We need to build onto those gains.
Absolutely. And, as we were mentioning, the rupee has been hitting new lows. So 83.28 is where the rupee closed yesterday. So it will be interesting to get some views on that as well this morning. Abhishek Goenka of IFA Global says the rupee has been under pressure as Brent has popped above $90 a barrel again. And FPI selling in domestic equities has continued into October. There's circumspection now on account of uncertainty around how the Israel-Hamas war will unfold. And this is fueling the dollar strength. Given these dynamics, he expects the rupee to remain under pressure over the short term, but to trade in a range of 82.40 to 83.70 over the medium term.
On bonds, we've got views coming in from Abhishek Goenka of IFA Global, who says that rising yields and volatile rates in the US have been influencing domestic rates. Lower than expected inflation print failed to fuel a rally, and people are generally confused as to how long rates will remain high. Upcoming GDL auction is likely to sail well, but at a bit elevated levels. In absence of any cues, he expects a 10-year here to be between 7.32 to 7.38%.
Right.
All right. Well, we have James Sullivan now joining us, Managing Director, Asia Pacific Equity Research at JP Morgan, to sort of tell us what he's making of the global situation. James, great to have you with us here. Thank you very much for your time. It's always a pleasure. Let's just start with what market prices are telling us, James, and let's just focus on U.S. rates. Yields sold off. They were down about 20 basis points last week. Is this a function of what the Fed has been saying, which has been quite dovish recently? Or is it geopolitics at play? What's your sense?
So there's multiple factors being priced into all markets right now. I think in particular to U.S. rates, the JP Morgan forecast is that the Fed will remain on hold in November. That is consistent with recent commentary from both Fed hawks and doves. I think the critical thing to look at in terms of the U.S. economy right now from a macroeconomic perspective are the cross currents that you're seeing between monetary policy, where you actually have seen significant tightening. You've seen the private cost of borrowing go up significantly, as well as a strong dollar constraining future economic activity. The flip side of this, and this is important because it is starting to change, is the fiscal policy out of the United States, where incrementally you've seen a 3.6 percentage point of GDP increase in the U.S. federal deficit on a year-on-year increase. That's a very large increase that is going to wane moving forward, however, particularly if you do not elect a Speaker of the House. Automatic sequestration will start to come into effect and dramatically reduce government expenditures in the United States, with the ensuing drag on the U.S. economy. So we are seeing very clear cross currents, with the big positive being taken out of the picture on a relatively short-term basis.
All right. James, good morning, and thanks a lot for joining in. For a market like India, this has been a really good year. Not so much for the frontliners, but a lot for the broader markets, right? The mid-cap index has done very well. And now a lot of the bad news has been sort of overlooked. The market has moved on, just giving us even more conviction on the upside. Do you think that it makes sense to put money afresh into the Indian markets at this price?
So as you know better than I, India is a very large, diverse country, so there's always a million stories to talk about. But today, let's focus on two together. One is the long-term structural story of the changes that we're seeing in the broader Indian economy. On JP Morgan forecasts, we're forecasting a more than doubling of manufacturing impulse to overall Indian GDP from roughly 17% today to roughly 25% moving forward. We're seeing a more than doubling of Indian exports from just under $500 billion today to over $1 trillion. And from a longer-term perspective, by 2030, we see the Indian economy more than doubling to $7 trillion US. As it makes that journey in 2027, it will become the third largest economy in the world. So I would argue that we are seeing a structural transformation of the Indian economy from a medium to long-term perspective. From a short-term trading perspective, the nifty generally tends to post on average about 13% positive gains in the 6-month period moving into an election cycle. So we have short-term tactical positive drivers, and I would argue very, very strong long-term tactical drivers that makes India a key overweight from a structural perspective from JP Morgan.
Good morning, James. Nigel on this side. That point on India is very well taken. And, in the longer term, we are definitely likely to do much better than our peer set. But what about China, the rank underperformer? Valuations are looking, fairly attractive, so to call it. But data points are still in a bit of a tizzy. How do you approach that market? Because everything's good at a price, right? Is China at that price, or would you all avoid it?
No, it's an absolutely critical point for us. So we are overweight China. with an expectation for a potential fourth quarter 23 or first quarter 24 rally. And the building components to that are very much in line with some of the points that you just raised. You have record low valuation levels. You have institutional investors that remain extremely underweight in their positioning in China. And really the critical thing for us to focus on here is the potential turnaround that we're starting to see, particularly in the August macroeconomic data points, where you saw fixed asset investment, you saw industrial production, you saw retail sales, all beat to the upside. At JP Morgan, we run a quantitative indicator to try to understand what stage of the business cycle an economy is in. And for China, that moved into the recovery stage for the first time in a long period of time. The one last data point that I would push from a China perspective is that you're seeing earnings revisions currently 1.5 standard deviations below the average since 2005, which is generally a time of peak negativity and the beginnings of an inflection point. So we do think that the data points are starting to show the potential for a fourth quarter, first quarter rally in China.
So in the near term, James, would it be leaning more towards China than India?
So it depends on time frame and it depends on investor risk appetite. From a longer term perspective, again, we see these massive changes in the overall structure of the Indian economy, which present very clear opportunities for sector selection within what we think will be a strong overall market. In China, we're very, very focused on specific sectors. If we can focus in line with government policy, if we can focus in deeply beaten down sectors that offer significant valuation support, then we see opportunity. So it's a slightly different portfolio allocation strategy in each market.
All right, James, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. So that's how you can approach the markets, both in India as well as across the globe. But let's do one thing. Let's take a quick break. On the other side, our list of top 10 stocks is lined up with our entire research team. Stay with us. CFC Bank, and our resident expert Abhishek is here to tell us, how the stock would react. Abhishek, largely it was a decent set of numbers?
Well, you would say a decent set of numbers given the fact that it's for the merged entity first quarter number that's being put out for SDFC Bank and SDFC Limited together. So what has stood out is that the slippages are at 7,800 crores, but take a look at the annual slippage ratio. It's at 1.34% when compared to standalone bank at 1.44% in the previous quarter. Now, the asset quality has improved. Gross NPA ratio is down to 1.34 versus 1.41% in the previous quarter. They have missed on NII with respect to our estimate, given the fact that there was ICRR rule by RBI and also, additional cost on the liability side that they took from SDFC Limited. PAT has come in at 15,976 crore, which is higher than our poll on account of two key reasons. One is the lower provision and the other is that they had a tax benefit. So lower tax rate this time around. Net interest margin is at 3.4% of the total asset. For the bank, it was at 4.1% in the previous quarter. And now, ex of ICRR, the net interest margin is on the lower side of their guidance. ROA, that's remained at 2%, and that's a fantastic point to know. And the RWA to advances, so risk in the balance sheet has reduced. RWA to advances ratio is down to 93.3% when compared to standalone bank being at about 103.4% in the previous quarter. Back to you.
All right, Abhishek, thanks a lot for that. Well, I'm looking at Grasim. We're waiting by for their fundraising plans, and they came out with it last night. They said that they're looking, at raising, they got a board approval to raise close to 4,000 crores via the rights issue route. They also say that in case, it's not subscribed, then the promoter entity, they're more than happy to go ahead and subscribe for the unsubscribed portion. As of last reported number, the promoter entity holds roughly around 43% stake in the company. What will this proposed rights issue, whenever it's announced officially, get used for? For CAPEX, for some borrowed part repayment, and also for corporate purposes. The street actually will breathe a sigh of relief that they've come out and said this. There was some doubt whether or not it'll go to group companies, namely Vodafone Idea, but now they've categorically come out there and assured investors it's for these purposes itself. The last reported debt was close to around 3,500 crores. That's moved up from around 1,700 crores to around 3,500 crores. And the proposed CAPEX is close to around 6,000 crores for the year. In the first quarter, they've done close to around 1,400 crores. So expect the stock to open up in the green. But Sonia, you believe that CET's numbers were good enough as well. That opens up in the green.
Yes, I'm going with green over there because the margin expansion is, quite good, and that is something the street would perhaps latch on to. Margins continue to surprise positively for CEAT. In fact, there's a 230 basis points gross margin expansion sequentially for the company, and that's because of two reasons. One, the product mix has improved, and two, raw material costs have softened. Now, when I say better product mix, it's because the number of trucks that they sold in Q2 is lower than Q1, and the two-wheeler contribution has increased in Q2, so hence their product mix has improved. If you look at the core numbers, the revenue growth is still in single digits. It's just about a 5.5% growth. But on the EBITDA, big jump is what you've seen, more than double this time. The margins have gone to almost 15% versus 7% year on year. Of course, same time last year was a low base as well. But if you look at the net profits, 208 crores versus 8 crores, same time last year. There's an improvement in cash flows as well. The first half of FY24, the cash flows from operations stood at 7,736 crores compared to 4,000 crores last year. So I'm going with green for CEAT. But Jio Financial Services and Bajaj Finance are definitely going to be in focus today. Abhishek has the latest on that. Abhishek, over to you.
To begin with, Jio Financial dividend income was at around 217 crore versus nil in the previous quarter. So the net income has grown robustly by more than 50% on a sequential basis to 608 crore versus 404 crore in the previous quarter. PAT is more than doubled in the previous when compared to last quarter. It's now at 668 crore for Q2 when compared to 332 crore in the previous quarter. Bajaj Finance, they will acquire 26% in Pennant Tech for about rupees 267.5 crore. Now, the Pennant is a technology product company, so the objective of this investment is for strengthening the company's technology roadmap for Bajaj Finance. Back to you.
Okay, well, Abhishek, thank you very much for that. Well, let's focus on a few other numbers which came through. Cyan DLM reported numbers, and so did ICICI Securities. Surabhi is here with details on both those. Surabhi, hi, morning.
Good morning. So for Cyan DLM, it was a good revenue growth, but the margins were under pressure, and that is why I'm going with red. They saw a revenue growth of 72%. Gross margins were down 500 basis points due to higher cost of materials. EBITDA margin was again down by 500 basis points, and that is also because of unfavorable business mix, that is higher revenue from the low margin products. The order book declined 10% due to the seasonality factor. Overall, the good revenue growth, but margins under pressure. ICICI Securities, good set of numbers. The revenues were up 34% sequentially. The PAT was up 56%, and the cost to income ratio came in at 44% versus 45% in the last quarter. So again, good set of numbers from ICICI Securities.
Okay, we will be joined by the management of Cyan DLM in a short while from now. So, Surabhi, thanks a lot for that. Well, Sonal is with us. She's going to give us some more stocks that are in the news this morning. Sonal, what's on your list?
Good morning, Sonia. 3 stocks on my radar today. Let me start with Godrej Properties because CIDCO, which is the City and Industrial Development Corporation of Maharashtra, has cancelled order for 2 plots allotted to company in Navi Mumbai, and the company does not agree with that. The company says cancellation is not tenable, is on untenable grounds, and it is in contravention to Bombay High Court's order dated May 3rd, and they've also challenged this cancellation order. So it will be an ongoing story. So we'll keep getting you updates on this one. Just Dial, where Karnataka Industrial Areas Development Board has cancelled the allotment of land situated in Bengaluru Urban District. The company says the financial impact of this cancellation would be to the tune of 19 crore rupees. Largely JK Paper, because they made an acquisition. They will be acquiring 100% shares of Manipal Utility Packaging Solutions. Packaging Board has been doing really well, the paper segment for them. So this is an expansion in that category.
Okay, all right. Thanks a lot for that, Sonal. Well, let's do a quick recap of all the stocks we just covered for you. Stocks with positive news flow. They include HDFC Bank, Grasim, CEAT, Jio Financial Services, ICICI Securities, JK Paper, as well as Bajaj Finance. Well, stocks with negative news flow include Cyan DLM, Godrej Properties, and Just Dial. The good news overnight, though, was that crude oil prices slipped a little bit. Manisha Gupta joins us to tell us what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, absolutely. The crude oil prices, which gained 7.5% in the previous week, have seen some profit taking coming in right now. 3 reasons for that. One is that U.S. could relax sanctions on Venezuela. There is a conversation on. There are a lot of ifs and buts on that, and it could take some time. But then the crude prices do move on sentiment, and that's exactly what we are seeing right now. The second is that there is no immediate escalation in the Israel-Hamas war. The U.S. president is visiting Israel on Wednesday, so markets are taking that premium off as well right now. The third thing is that we are looking at higher production from US, and the US inventories gained up by nearly 11 million barrels in the previous week, and that also has led to some decline coming in for prices. Having said that, we still are meandering around that $90 a barrel mark for the crude prices, so some support could continue going forward.
All right. Thanks a lot, Manisha, for that. So that'll be the big event to watch out for, the US President's visit to Israel and what happens as far as the de-escalation is concerned. The situation, of course, as we know, has really gone out of hand, with several civilians losing their lives on both sides. And it'll be interesting to see what the outcome of that meeting is. Let's take a short break on that note. On the other side of the break, we'll be joined by Siddharth Khemka of Motilal Oswal Financial Services to discuss fundamental stock analysis. We'll also be joined by Anthony Montalbano, who's the CEO at Cyan DLM, to discuss their Q2 performance. Stay tuned.
Welcome back. Hope you're having a good morning. Well, the gift Nifty is suggesting that we open up well in the green. So let's see how that goes. But plenty of stocks to discuss. To help us out with that, we have Siddharth Khemka, the head retail research at Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Good morning. Well, the Nifty has got to chase down these runs, so to call it today. And the captain of the ship needs to do well. HDFC Bank. What's your view? Do you believe its time has come at around this 1,530 rupees odd? Would you be a buyer? Are you constructive on the stock from here on?
Very good morning, Nigel. If you look at HDFC Bank, I think finally the bank has kind of overcome the merger overhang, and now they reported the first merged entity results. And to be honest, it was, you can say, mixed, but not that bad, given that the initial feelers that we got was a bit on the pressure side, that the expectations was built on the lower side. And hence, I think the numbers kind of delivered in line with expectations. If you look at the key numbers, yes, the PPOP and the NII were both in line. The business growth has been quite robust. PAT was aided by lower tax and lower provisions, but higher than expectations. Margins, if you see NIMs, a bit tad lower. It was expected to get compressed, but a bit lower than expectations. So I think the street would be broadly okay with these kind of results. The good part is the management commentary saying that growth from here looks pretty strong, and they would only build up from here. As I said, they reported a beat on profitability owing to healthy other income and lower tax rate. Loan growth was healthy, driven by the growth in retail as well as continued traction in the commercial as well as rural banking. There is enough buffer for with the PCR at 74%. Hence, we believe that HDFC is making a good beginning and has a huge pace of capacity building, which is with the levers in place for the strong business growth, which is key for the market to start rewarding. The stock has kind of underperformed in the past, and largely because of the overhang of the merger and how the numbers would look like post the numbers. From here, we are expecting HDFC Bank to deliver an 18% loan and 20% deposits CAGR, which should lead to a 21% growth in earnings and translating into a steady ROAs of 2%, ROEs of 17%. So I think the ship is steady from here, should start delivering returns to investors. We definitely have a positive view and a target price of 1950 with a one-year target of 1950, which gives a decent 30%, 27-30% upside from current levels.
Okay, 1950 is your target price. That's a big upside from the current levels. The other stock I wanted to discuss with you was CEAT. Now, there's been a steep rise in profitability, a big jump in margins as well. But the stock also, if you look at it in the last 6 months, is up about 50%. Is there more scope on the upside?
Sonia, if you look at the auto anchors, they have been doing well after the supply chain issues that got resolved. Demand has been pretty strong. And if you look at the key segments, passenger vehicle segment has kind of done well. Specifically, if you look at CEAT, the overall business growth was strong. Net sales grew just 5.5%, 4% Q on Q. And it was kind of a sequential increase in the volume was led by strong OEM demand, which was kind of filling in the inventory before the festive season. Replacement and exports volume has been pretty stable. The good part is the margins, gross margins expanded almost 10 percentage points Y on Y, and on a sequential basis, 230 basis points on a Q on Q basis, which is quite heartening to see, especially for a commodity business like tires. So I think overall, the numbers have been pretty good. The company has kind of lowered its debt also. EBITDA has been pretty good, and the demand looks quite strong. We have a positive view here again, and kind of look at the entire auto ancillary space with a positive view. So we have a target price of 2850, again more than 30% upside, you can say, from current levels.
Okay, all right. Just stay on. We'll come back to you, Siddharth, in a bit. We have another stock that we're going to discuss right now, which is Cyient DLM. It's the first corporate interaction of the day. For Q2, the company saw very strong revenue growth, although their margin took a hit because of elevated material and employee costs. Anthony Montalbano, who is the CEO at Cyient DLM, joins us now to talk more about their performance. So this was, what, a 72% growth that they saw in their top line in Q2 FY24. Anthony, can you just take us through that? What is the expectation as we move along, and which are the segments? I mean, you have an exposure across segments, right? Whether it's aerospace, defense, industrials. Which are the segments where you saw maximum amount of growth this time? And is this a run rate that you can sustain through the course of FY24?
Yeah. Yes, very nice to be here. And yeah, we did have a very strong quarter as far as growth goes. This was a record quarter in terms of overall the business we've delivered in the history of Cyient DLM. And so the primary sectors that a lot of that came from is aerospace and defense, and then followed by industrial and medical. And we continue to see strong momentum in those segments. Those are our core focus segments, and the outlook in these sectors for our clients continues to be quite strong.
Mm-hmm. Hi, Anthony.
Sorry. Anthony, on aerospace and defense, I remember sort of having a conversation earlier, and with the Cyient management before the spin out, etc. And I remember them telling us that this is the segment which is entering a multi-year boom. This was I think about 3 or 4 months back. Has that started? Is that the reflection of the numbers that you've posted in this segment? And what's the sustainable rate of growth here for the segment?
Yeah. The cycles in these segments are quite long, right? Especially the aerospace side of things. And so really we've come out of a down cycle, and we do see a multi-year boom where there's a lot of investment happening. That includes investment in support of upgrades to existing product. And then, as you've seen in the headlines, there's been considerable product purchase made in terms of aircraft, which drives the associated, industry drive there. So this is an area we're strongly positioned in terms of the areas that through our clients, and then also just the nature of the programs that we're engaged in are very much long-term programs, often running 10, 15 years. So this is something we've had in our order book, and we continue to see the momentum, and this is what we're continuing to deliver on today.
Hi, Anthony. Good morning. This is Nigel on this side. We'd like to talk business and its impact as well. there's an unfortunate conflict going on in Israel, and that could have some repercussions for your business as well. So could you tell us what kind of revenues were you estimating to come in from Israel? And does that get altered because of the ongoing conflict? I mean, we all pray and hope that everything settles down. And, from a business perspective or for a humanity perspective, we don't want any of this. But for your business, what's the impact?
Yes, it's clearly a very top-of-mind situation. I was personally in Israel about a month ago, meeting with our key clients and stakeholders. The situation, of course, has changed significantly. We have reached out to all our key clients and just about all of our key suppliers in the region. I think only 2 that maybe we have not directly connected with. So that's like 2 out of 30 plus. So the feedback at this point is quite positive, where no supply disruption is expected. And so it is pretty optimistic from that point of view. That said, we are very cognizant of what's happening in the region, potential impact that one might guess in terms of logistics and other aspects of that. So we are continuing to monitor it very closely. Right now, early indication is that, it is no change in any guidance. And but again, there's a lot happening there that we have our thumb on the pulse on.
Right, Anthony.
To answer your question about...
Anthony, you were earlier guiding for around 100 crores, right, of business from Israel? I think that was the ballpark number. So you'll stick to that.
We see about 20% of our business at this point in time coming through there, and in one form or another. So that is associated with some of the defense business that we have, and so that will also change over time.
Right. Anthony, just trying to understand a little bit better. You'll end this year closer to around 1,000 crores of revenues. Going by the run rate that you've done. Last year, you did, I think, 850 crores odd. So out of the 1,000 crores approximately, you'll get to 1,000 crores first of all, right?
So we are forecasting. We're looking at a growth rate of, right now is a run rate that we're on for our business. We plan to continue with that run rate. We're going to continue to drive growth in, the range of 30 to 50%, maybe 40% plus, depending how it executes.
Okay, and out of that, 20% comes in from Israel.
Some of the supply can come out of Israel. I would say somewhere around 20%. There could be some impact. If you look at the supply chain aspects of it. But that's the current makeup of it overall. So probably somewhere just shy of 20% might be related to supply chain coming out of Israel.
Okay, so 20% comes in from Israel. Of course, we hope and pray that the situation doesn't escalate further there. But, coming back to your own business, you also raised 700 crores in the IPO for inorganic growth opportunities. Have you been able to identify anything yet? And any kind of timeline that you're looking at for acquisitions?
We actually have made quite a bit of traction in that regard. We are in discussion with, I'd say, a few key opportunities. And so we would like to be in a position where in the coming quarters, we would be able to potentially announce something which would broaden our capabilities and footprint that we can extend to our current clients, as well as potentially open up some other areas that we can expand globally. So there is some positive momentum there, and as we get further along, we discuss specifics there.
That's interesting. So you're saying over the next couple of quarters, 2 to 4 quarters perhaps, you can close in on something, and you've identified a few opportunities. Just 2 more questions on that. Are you including that in the 40% growth that you're looking at for FY24 or not?
No.
And once,
no.
Okay, you're not. Got it. And what are the opportunities, which are the areas where you see maximum opportunity for inorganic acquisitions?
Yeah, so all our numbers are organic that we are putting out. So inorganic would definitely add to that. And our core, as far as the types of inorganic pursuits that we look at, it really is along the lines of the low volume, high mix, high value, air and defense, industrial, medical, and then again, we have capacity and capability in India. A lot of our clients, in terms of number count, are Western based. So as we look at providing solutions closer to those clients, that opens up more business potential there in new products, and that's part of the strategy that we're moving forward with there.
Very quickly, Anthony, you can do 8.5% margin, so you can improve it very quickly.
Yeah, so from a margin perspective, a lot of that comes down to business mix, and so this last quarter we had a lot of revenue associated with some lower margin product, and then also we have made some investments in go-to-market and people, and again, when you have this type of business growth, you have to make those investments.
All right, Anthony, we'll leave it there. Thank you very much for your time. Good speaking with you. And pleasure, as always, here on CNBC-TV18. We'll take a very quick commercial break here. We'll come back. Anuj is here with the setup as he's seeing it. And, of course, we'll focus on technical trading ideas. Our guests will be with us. We'll also, of course, get a F&O view as well. Stay with us. Okay, welcome back. There's 14 minutes to go for the pre-open session. Anuj is here with how he's seeing things. Anuj, morning.
Morning, Prashant. Like your tie. Interesting, huh? Trying to get a bit younger, is it? Looks quite interesting.
Little things, huh, Anuj? That's all there is left now.
Nah, it's okay. Just, that's the first thing that I noticed when I walked in the studio. But anyway, let's talk about the market. I think, this is a phrase that I use. A market which refuses to go down on bad news is going up. It's as simple as that. I know a lot has been thrown at the market over the last few days. Whether it's crude prices, the war, higher bond yields, dollar index, FI selling, and the market's been making higher lows and higher highs. The October series high, for example, has been higher than the September series, and last 2 or 3 days, the market's been making continuously higher highs. I know it looks like a matter of when and not if the Nifty makes a new high. The bull market really climbing classical wall of worries. Fin Nifty's expiry today. You have HDFC Bank and Bajaj Finance in focus. HDFC Bank's ADR implies, given that stock was weak domestically, a 2.5 to 3% gap up. It will be interesting to see if that actually happens and then what happens after that, because the numbers were slightly better than what the street was fearing. In terms of the Nifty outlook, it's now confirmed a higher low. The low yesterday was 19,691, which is higher than the previous low, or the Friday low, which was 19,635. So that's the 2 levels that I'm watching out for in today's trade. As far as Bank Nifty is concerned, in that I'm breaking down with individual stocks, because SBI yesterday took support at the 200-day moving average. ICICI Bank repeatedly taking support at the 20-day moving average. Axis Bank bouncing back from 50-day moving average. Need to see if HDFC Bank can now sustain above the 200-day moving average, which is placed at 1543. On the index, the 2 levels I'm watching out for: 44,356, yesterday's high, and 44,563, which was Friday's high.
Okay, Anuj, thanks a lot for that, and have a good day. We'll, of course, be seeing you again very soon. But for now, Siddharth Khemka is still with us, so let's get some more calls out of him. Siddharth, Bajaj Finance is the one that everyone's going to be tracking this morning. I mean, today, because of the numbers. What's your expectation this time around, and how are you positioned on the stock?
Yeah, Sonia. So if you look at the overall earnings, we have been pretty positive on specifically if you see the banks and the financial services. So that is, and within that, Bajaj Finance, we are expecting to lead from the front. Overall, for the NBFC lending business, we are expecting a 26% NII growth and a 35% PAT growth for the quarter. This is for the aggregate lending NBFCs within our coverage. And within that, if you look at Bajaj Finance, which has already reported a 33% YoY growth in its AUM, NIMs will kind of contract marginally 30 basis points, but the asset quality will see some improvement is what we are expecting. So overall, as I said, OPEX likely to moderate, credit cost is expected to decline, and net profit growth of 31%. to 36.5 billion. So I think a pretty steady quarter from the market leader in the NBFC space. We are quite constructive on Bajaj Finance and target price of excess of 9,000 there.
Siddharth, what about Grasim? You know, they've come out, they're saying they're going to go ahead with the rights issue and it'll be a small dilution, you know, at 4,000 crores approximately. The bigger news is that they've clarified that no, none of that money is going to, group company, because they've listed out capex, debt repayment and corporate purposes. So lending to group company doesn't come in there. How do you view the stock from here on?
Yeah, Nigel, so I think the clarification was much needed, especially when you have a group company in the telecom business, which is bleeding money and requires a lot of capex infusion. But I think the fundraise for Grasim will be a positive step. It will definitely elevate the pressures on the balance sheet. If you look at, the company has undertaken substantial capex of almost 10,000 crores in the new growth sector, specifically the paint business. And the management, as you rightly highlighted, has outlined a capex of 5,700 crores for FY24, which includes business almost 4,300 crores for the paint business. I think definitely the core business, if you look at for the Grasim, the caustic soda prices have started to improve, which should be beneficial from Q3. The VSF prices has also started seeing improvement in the global markets, and that should also kind of start helping the other business for Grasim. So I think this fundraise will definitely improve the balance sheet and should lead to some improvement in the overall valuation. Our SOTP target price is 2380, which is about 20% upside from the current levels.
All right. Thanks a lot, Siddharth, for joining in, and have a great day. That's the word on several companies and how you should be approaching them. But we have a market to trade in just a while from now. Mitesh Thakkar and Sudarshan Sukhani are joining in. Gentlemen, morning to both of you. Sudarshan, I want to start with you first. There is a lot for the bulls to be, thrilled about today. HDFC Bank's numbers are decent. Global cues are positive. There's been large buying from domestic institutions. Do you think the trend is upwards?
Yeah, good morning. Well, that seems so. Yesterday we had a narrow range day, and what should have been a down day was not so. So that itself tells us that the market is not willing to seek lower levels. Now, after a narrow range day, a big expansion usually comes about, not always, but usually. That seems to be likely today. So the trade is be long in the Nifty. Actually, even yesterday I had said if you see a dip, you be long, but that dip never came about. But today, at the open, after the first few minutes of cooling in, I think it's better to be long in the Nifty and the Bank Nifty both. The Nifty should continue to outperform, but you never know. So it's best to take long positions in both of them.
Okay. All right. Better take long positions in both of them. Mitesh, what about you? We're expected to open 60, 70 points higher. How do you approach trade? Would you look to buy immediately? Do you look to buy the dip, or will you stay away?
Morning, Nigel. My feeling is to stay away for the simple reason that my belief is that the market is still consolidating, will be volatile, but overall ranged. And I'm not sure whether the Nifty has the strength to get past 19,850 levels. And therefore, I think, if you open about 60, 70 points higher, then the upside left on the table for the immediate target is very limited compared to the risk which you'll take. So I think I'll avoid trading the indices for the time being. The belief is that 19,850 to about 19,650 remains the immediate range. In the worst case scenario, we might see 19,500 in the short term, and next few days, I think, will be spent within this 200 or at the max 350 point kind of range.
All right. What about individual stocks then? Sudarshan, what are we looking at this morning?
Well, I have a mix. Tata Communications is an intraday short, and the stock has probably started a correction of some kind. So we'll just see how long it continues. Short with a stop above 1820. Havells is in a trading range. That trading range, as we see mostly in bull markets, breaks on the upside. Buy Havells with a stop under 1370. NTPC is a buying opportunity. It's on the verge of a breakout, and that would be a significant breakout to new highs of this period. So buy with a stop under 241. And finally, I have Tata Steel, which is a buy. So I have actually 3 buys and 1 short sell. Tata Steel is a buy. It's completing its correction. Buy with a stop under 125.
Steel was doing very, very well yesterday. I mean, actually, JSW Steel, Tata Steel, and a bunch of others as well. Mitesh, what about your trades?
Morning, Prashant. A similar kind of an outlook. I have 3 buys as well to a sell. On the buying side is Motherson Sumi. That's a buy with a stop below 94.5. Look for targets of 104 to about 105 on the upside. A buy on Container Corporation, and we've had a buy on this stock in the last couple of days earlier as well. Now can be bought afresh. Keep a stop at 707. Look for targets of 740. And a buy on Aditya Birla Fashions. Keep a stop below 223 here and look for an immediate target of 237. While one sell call, that's on DVs, and that's a conditional sell because we are opening with a positive gap up. If it starts trading below yesterday's low or the pivot of 36.35, sell with a stop at 36.60 for a target of around 35.55.
Okay, one sell, but yeah, mostly buys. Just one name, Mitesh, Gokuldas Exports saw a very large 8-9% move. And the interesting thing is that with yesterday's move, it has taken out the August highs. I mean, I think the high was made on the 30th of August after that acquisition they made. And with yesterday's move, it's taken that out. How is this one looking?
So, Prashant, have been very bullish on this stock for quite some time now, and the long-term charts still remain very strong. In the short term, though, if you look at the last 5 days of movement, it's moved up from 770 odd levels to now at about 950 thereabouts. So maybe not the best entry point, but I think this stock will continue making higher highs, and I have a target of around 1150 plus here. So if somebody's holding, keep holding, and the idea should be to use bad days or declining days or red candle days to accumulate the stock slowly. I think now stop below 800 would work. So anything closer to about 850, 870 would be the start of an accumulation zone.
Okay, all right. Let's take a quick break on that note. Thanks, gentlemen, for giving us all of those ideas. When we come back from the break, we'll have the pre-opening rates. Also, Rahul Malani of Sharekhan will put focus on the earnings performance of the banking sector, specifically HDFC Bank, and how you should approach that one. More on that coming up. Well, we're heading into the market pre-opening rates in just a bit. In the meantime, Sneha Seth is joining in. She is the research analyst of derivatives at Angel One. She's joining in now. Sneha, hi, good morning, and thanks for being with us. How are you feeling about the market? Do you think it's trending upwards? And if yes, what are the levels to watch today?
Very good morning, Sonia. If we see market, yes, I believe that 19,700 has become a good support zone, and I believe any move beyond 19,800, 850 would be really interesting to watch, and we can head towards 20,000 odd levels. So from now, I believe any dips should be bought in, and one should prefer trading in individual counters as well. So my 2 stock picks are there, which is again on the long side. The first one is DLF. DLF has formed a strong base around 260 to 61 odd zone, and I believe with a strict stop loss of 560, 565, that zone has become a good support zone. So I believe we can go along with a strict stop loss of 561. The target you can expect is around 601, 602 odd levels, and again. Apart from this, auto space has been doing quite well. So Ashok Leyland, this counter has been consolidating. I feel that it may resume an up move from here on. So I believe we can buy this counter with a strict stop loss of 173, and target can be expected around 184.
Okay, thanks a lot, Sneha, for that. Have a good day. That's Angel One with their views. But HDFC Bank reported a mixed set of second quarter earnings. It was largely a positive set, actually. Asset quality has improved. You've had growth. The commentary from the management was positive in terms of growth, as well as the loan book. The loan growth that they saw was 5% quarter on quarter on a pro forma basis. So let's listen into some excerpts from HDFC Bank's MD and CEO Sasidhar Jagdishan, his comments during the earnings conference call, and then we'll try and analyze the numbers as well.
The presentation which they did to the analysts brought out some of the one-offs on account of the debt-funded liquid assets to meet the liquidity coverage ratio, the LCR, as per banking norms. As you know, sometimes the assumptions and cash flows that an NBFC does is different from that what a bank would do, and so therefore there was some amount of build-up of liquidity to meet those liquidity coverage ratio norms, and also provide an extra cushion to take care of contingencies. As luck would have it, there was an incremental CRR which was announced, and this cushion came in extremely handy. Obviously, it came with a cost, which is approximately 25 basis points. The core margins on a total asset basis on a pure arithmetic should be somewhere between 3.7 to 3.8. So when you adjust for this 25 basis points, we are at the lower band of the 3.65. But that's all right. I mean, that's something that I'm sure with time, we will recoup some of the margins as we substitute the high-cost bonds with deposits and the changing mix of our business loans mix more and more towards retail. Bank is poised to silently deliver the core growth that you have just seen in this quarter, and I'm very confident and sanguine that it will continue to do so quarter after quarter, even on a larger scale. Maintain the profitability in the range of 1.9 to 2.1% as in the past. We are extremely excited about this merger, and we will slowly but surely demonstrate to the world that how we will execute the way we have done in the past.
Okay, well, there is commentary coming in from the top management at HDFC Bank. We have Rahul Malani, equity research analyst at Sharekhan, now joining in to weigh in on the numbers. Rahul, good to have you with us here. There's a lot of sort of commentary around this in terms of how the numbers are not comparable. But simplify the numbers for us. I mean, are the numbers better than what the street was expecting, what the consensus was expecting? And are there any big surprises? Go on.
See, first of all, good morning. Overall, if we talk about at the NII level, it missed estimates and consensus by around 3 to 2%, in the range of 2 to 3% for the overall consensus. But if you look at the broader things in the at the bottom line, it managed to report a 2% ROE based on the lower credit cost, higher other income, and basically one-off item in the led by the lower tax provisions due to the favorable appellate order. So we believe that sustainable ROE trajectory for the merged entity is expected in the range of 1.6 to 1.8% versus the management guidance of 1.9 to 2.1%. And we believe that NIMS pressure has bottomed out and would see gradual improvement over the next 12 to 15 months in the NIMS. And deposit accretion should be a key monitorable from here on. And one important factor from here on is that the loan growth. We expect loan growth to be in the low mid-teens versus the consensus estimates of high mid-teens. Because if we look at the CD ratio, which is considerably higher than the industry level at 207%. So the choice is here. The choice lies with the management here. There are two paths. Either slow down the growth, improve the liability profile, normalize the CD ratio, and then get back to the growth trajectory. Secondly, or deliver better than industry growth, or there will be at the same time there will be gradual improvement in the liability profile, as well as there will be gradual normalization of the CD ratio. The later would result into a slower recovery of the multiples for the bank.
Okay, all right. Hi, Rahul. Good morning. So it appears that you will wait and watch. Most on the street of the consensus this morning is HDFC Bank will not underperform from here. But it seems that you want to see a couple of quarters of recovery first, and then you'll get more constructive on the stock. What's the official rating, by the way?
We have a buy rating on the stock with a target price of around 1900. But we believe that there will be slow and steady improvement in the ROA. Once you see a sustainable improvement in the ROA led by led by NIMs, we should see translating healthy returns in HDFC Bank for the next 12 months. But we believe that stock is likely to consolidate in next 12 months.
In the next 12 months. So you're not seeing any kind of move on the stock from these levels over the next 12 months, is it?
Yes.
Oh, okay, that's interesting. Contrary to the views that we got earlier on the show, fair enough. Any other banks that you're looking forward to in where there could be, a big surge in growth this time around, where there is also valuation upside?
We like mid-tier private banks. Currently, they are they are outperforming the industry in terms of earnings growth, as well as the outlook remains positive. So overall, in terms of valuations also, valuations are very handy for both the mid-tier private banks in our coverage. That is IndusInd Bank and Federal Bank. So we like both the stock from near-term perspectives, and it's likely to outperform the bank nifty.
All right. Thanks a lot for that. Have a great day. We are heading into the market opening, so we'll take your leave on that note. That's the word on HDFC Bank. By the way, let's just get the stock up for you. There are so many stocks today that you need to look out for. HDFC Bank is the one that's up almost about 2% on the back of a decent set of numbers. But one of the stocks of the moment in the broader markets is CEAT. After a very good set of numbers that the company has posted, big improvement in profitability this time for CEAT. The stock is up 10.5% right now. Sudarshan and Mitesh are back with us. Sudarshan, what's the big call at 9:10? And how are you feeling about a stock like CEAT? After this 10% rally, is there more to go?
Well, for Tata, the stock is Tata Steel, where buying is suggested with a stop under 125. PI is an investment idea. So for an investment idea, 10% gap up is irrelevant. And if you really have to take a time frame in mind, that should be 1 to 2 years. And it's worth buying if you have that time frame.
Okay, all right. Thanks for that, Sudarshan. Mitesh, what about you?
I'll go with the buy on Motherson Sumi with a stop at 94.5 and a target of 104.
Okay, all right. Thanks a lot for that, gentlemen. Well, in pre-open itself, HDFC Bank, that's the big mover, and the markets are likely to open a little higher than what we saw last week. We did a U-turn from these levels of 19,840 odd. So building on from here is going to be extremely crucial. We'll get to that in a bit. Let's run you through Dalmia Bharat. And the reason we're looking at is the few big con-call takeaways. The pricing growth of close to around 30 rupees in East as well as South India, it's sustained. It's been absorbed. So that's good news. The volume growth, they say, could lag for one more quarter, but they expect it to outperform from quarter 4 on. Remember, for the first half of this year, Dalmia Bharat in terms of volumes has been a bit of a laggard. And also, they have lost market share as well. JP acquisition, that's likely to be completed by the end of this fiscal. And the capex they've put out is around 6,500 crores. 3,500 crores out of that will be for the JPA asset. Two views out there. One is on Nomura. They have downgraded the stock. They say because they're lagging, because they've lost market share. They expect the JP deal to get closed out only in the first half of next year. The management is guiding for the end of this fiscal. While Jefferies, they retain their buy rating and they've upped their target price as well. They're expecting a far better showing in the second half of this fiscal. So that's why they're positive. But Sonia, are you looking at CEAT?
Before that, actually, Hero Motors come out with an update. They've sold 1,000 Harley-Davidson X440s across 100 dealerships. Wow. That's a big thing. Are you one of them?
No.
Did you book?
My neighbor in the other studio is.
Anuj just booked, is it?
Yeah, I think so. I saw some pictures of it. I don't think he's going to go for a test ride.
So. Okay, well, one of the 1,000 that has been booked, it's big, I mean, this whole premium space is picked up in a huge way. The other space to look at is the tire space. I mean, somebody's got to make the tires for these companies. As CEAT, just look at that, 10% higher now. Just to quickly give you the numbers in case you missed them, the margins continue to surprise positively. The big positive this time is the 230 basis points quarter-on-quarter up move in margins. That's because, one, the product mix has improved. That is higher two-wheelers. As we were just looking at it, I mean, these two-wheelers are flying off the shelves, especially the premium guys. So CEAT's two-wheeler contribution has gone up, and that has resulted in a better margin performance for them. Apart from that, there's, of course, lower raw material prices as well that has aided them. So revenue growth is nothing to write home about. So it's a 5.5% growth. It's the EBITDA number which has more than doubled, and margins have come in at almost 15%. They've also seen an improvement in cash flows this time, a significant improvement, and that's what the street definitely likes. Two brokerage notes that I have. One is from Equirus, where they said that two things, the focus on product mix and judicious pricing is what helped improve margins. And Elara Capital has said that the read-through for Apollo and MRF is positive. but it's more to do with the lower raw material prices, which will aid Apollo Tyres and MRF. For CEAT, because they have a higher contribution in the two-wheeler space, that's why, they've seen a big amount of up move there. But let's hop across to Ekta. She's tracking Divi's Laboratories this morning. Ekta, over to you.
Thanks for that. Well, yes, Bernstein has written a note on Divi's Labs. They had initiated coverage a couple of days ago with an underperform rating and a target price of 3,064. Now, the fresh note analyzes the export trends in the last 6 years for the company. So they indicate that Big Pharma is around 44% of sales. Within that, there are a couple of molecules such as sacubitril as well as valsartan. Valsartan standalone, sitagliptin are their largest products. Now, within generics, which is around 50% of their sales, naproxen and a couple of others such as gabapentin are their largest products. Now, the product concentration as per Bernstein has reduced for Divi's over the last 6 years. Top 10 customers are 69% of sales in 2023. It used to be 92% in 2017. Customer concentration has increased, however, slightly to 61% in 2023. Now, competitive offerings, they are the lowest export price in several key molecules, so that's definitely a positive. In segments such as peptides, there are no sales for big companies such as Novo Nordisk as well as Eli Lilly as yet. They've gained several new customers in 2021 and 2020, and most have been retained. With regards to the China Plus One factor, they are not sure if that is a valid tailwind.
Okay, thanks a lot, Ekta, for that. Well, we have just, I think, 2 more minutes left for the markets to open. A couple of stocks that I wanted to mention. One of them is KEC International. That stock is up almost about 5% in pre-opening on the back of an order win. Jio Financial is also up about 3%. So lots of earnings reactions on the upside this morning. There's ICICI Securities, which is up almost about 4%, so looking pretty good there. And of course, the OG, the heavyweight, HDFC Bank. Sign DLM is up about 2.5%. In the broader markets, the stock to definitely watch is CEAT, up almost about 10%. So lots and lots of positive reactions coming through this morning. The Nifty looks like it's going to hold on to that 19,800 mark. And we also have support coming in from across the globe with an over 300-point rally that we saw on the Dow overnight. We had good buying from domestic institutions as well. So in all likelihood, it will be a positive opening. The important thing to watch, though, will be whether we hold on to these gains or not. That's crucial. Although the market has been making higher highs over the last, couple of weeks, we have seen some trepidation because of geopolitical tensions. By and large, this market has been trending higher. So that's something that we can watch out for. In terms of other stocks, Bajaj Finance will be coming out with their numbers today. So we're going to watch that very closely as well. And from the heavyweights, IT stocks are something that perhaps may support the market this morning. At least that's what the early indications are. Names like HCL Tech, etc. are trending in the green. Hero MotoCorp as well on the sale of those Harley-Davidson bikes, looking pretty good. Here's the first take on the index. Straight off the back, it's a 100-point up move on the Nifty. The Sensex is up almost 370 points now. So looking pretty good for the market. The Bank Nifty is up 300 points. Top of the charts is HDFC Bank, 1.5% higher. Grasim following suit, up 1.5% as well. And Divi's Labs is up about 1%. Hero MotoCorp is also up about 0.5%, so looking pretty good there. While you have something like an LTI Mindtree that's batting for the bulls this morning. On the downside, barely any stocks. So Dr. Reddy's is the only one that's down about, and that too barely about 0.1%. Otherwise, it's a very, very good looking market. 19,800 now on the Nifty, holding with some effort. And the advanced decline ratio as well is well in favor of the advances. But plenty of action in the broader market.
Well, that's right, Sonia. The stock of the morning has to be CEAT. That stock is flying away. And what it's done is it's had a positive rub-off, both on MRF as well as Apollo Tyres. Both of them are up more than 2%. So keep an eye out on both those two. Delta Corp, the stock is half of what it was a few months ago. That stock has opened up with a gain of close to around 1.5%. Grasim, they have announced a rights issue and they're saying they're going to be using it for debt repayment for the capex plan as well as for corporate purposes. So that doesn't include any kind of money going to a group or company like Vodafone Idea. So that's why the street likes that. The stock is up in today's trading session. A few other notable movers with big volumes. SCPC, now that stock has moved, with large volumes. So just keep an eye out on that one. PC Jewelers, one of those stocks that have been a rank underperformer actually. But that one, in fact, is up close to around 7%. Big volumes out there. MMTC, limited float, but the stock doesn't budge. It's just moving one way upwards. But caution on board out here. The free float in the market is very, very limited, only around 7% in the market. JK Tyres, well, that's another one that's up close to around 5.5% this morning. And Bank of Maharashtra as well came out with its set of numbers yesterday. That is up more than 2%. Suzlon Energy as well continues to move up close to around 2.5%. So quite a few gainers. But if you look at it from the highs of the day, we have slipped close to around 25 points. So unable to sustain above that 19,840. Still early days. We need to get back to those levels and sustain over there. That's what could trigger a big short covering bounce. For the time being, HDFC Bank, stock of the morning.
Well, absolutely. And, the market, by the way, is up, 85 points now, 19,800 plus on the index is where we find ourselves at. And it's a very, very good opening. I remember the tire names. I think it was a quarter before, not the last quarter, but the one before that. MRF came out with numbers, big beat, and that sparked a rally in tire stocks, which lasted for many weeks. We're going to see a repeat or something like that. We'll find out, but their entire pack is doing well on the back of what, of course, CEAT has done. A few other names. You've got ICICI Securities, which is up 7%. Stocks at about 674. That's a very large move coming through. Latent View is coming up with a 4.5% gain. Stocks at 429. I think we mentioned Scient DLM, which is up 6.5%. Stocks at about 734. KEC is another one, which is up 4% this morning. Bombay Dyeing is up about 5%, 159 on Bombay Dyeing. There is Viatech Vabag, which is up about 5.5%. Karur Vaisya is up about 1.7, 1.8% as well. So, it's a market which seems to be starting on the front foot with lots of names participating in the broader market as well. Loda, that is Macrotech Developers, is starting with about a 1.5% cut. And yesterday we saw, out of the blue, a big rally in fertilizer names. FACT, Madras Fertilizer, Deepak Fertilizer. Today, maybe slight pullbacks, right? FACT is down about 1% or so, but nothing more. GNFC is down a little bit. But watch this space because these stocks were up 7-10% in trade yesterday. 85 points is what we have on the Nifty, 19,815 at this point in time. Harsha Upadhyay is a market master today. He's President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company. Harsha, good morning. Good to have you with us here. Thank you very much for your time. Actually, let's just start with the auto ancillary space and the numbers I'm sure you've seen what CEAT has reported. Your thoughts on it's a space which has been kind of a dark horse, has done very, very well. Not just the OEMs, but maybe OEMs more than auto ancillaries this year. Ancillaries did very well over the last 2 years. What's your view? I mean, tires as a space and, the sector as a whole.
Good morning, Prashant. Clearly, auto sector seems to be doing quite well in terms of the volumes. Whether you look at any of the subsegments there, all of the subsegments seem to be growing at a reasonable pace. So clearly, for auto ancillaries, this is a big boost as they get much of their volume from OEMs. And even the replacement market in many of the auto ancillaries have picked up. So overall, I think the growth trajectory for auto ancillaries seem to be quite strong. And we have also seen margins improving as commodity costs have moderated. Although we should keep in mind that crude has moved up and at some point of time in the near future, there could be some pressure on overall margins. But nevertheless, all auto ancillary segments seem to be doing quite well. And in particular, tires also seem to be seeing the benefit of lower raw material costs at this point of time and better margins. As we move ahead from a medium-term perspective, we still continue to be very positive. We do have a couple of positions in the tire segment in our portfolios. However, in the very near term, there could be some lag impact of higher crude oil prices.
Okay, Harsha, hi, good morning. By the way, the tire space is the one that's really on fire this morning rather. Not just CEAT on the back of numbers, but there's buying in JK Tires up almost about 8%. Apollo Tires, MRF, all doing pretty well. And I think it was expected that these numbers would be good given the lower raw material costs. But the additional positive impact of a better product mix where they sold higher number of two-wheeler tires and that helped them is something that has, given a fresh set of wings to a lot of the other tire makers as well. Bajaj Finance and Bajaj Finserv, the twins are also doing very well, topping the charts as we speak. Expectations perhaps that the numbers would be good this time. And there's additional news on Bajaj Finance as well. Harsha, hi, good morning. How are you feeling about the markets in general? What is the stand now? Do you put more money to work? If yes, What are the big themes that you're looking at?
Sonia, clearly the undertone in the market seems to be quite positive. While valuations are higher than average or fair range of valuations, I would say that the overall sentiment seems still positive. But we need to keep in mind that from here on, the stock performance would be dependent more on earnings deliveries. I think most of the near-term positives have already been discounted. So I think earnings delivery is going to be crucial for stocks to sustain these valuations or to move higher from these levels.
Hi, Asha. Good morning. Do you think there's a scope of disappointment? At one point in time, the street was very comfortable. Mid-teens growth, the Nifty EPS is very gettable. Now we could have some supply disruptions that are coming back, given the conflict that's picked up in Israel. It could have repercussions for the rest of the globe as well. Do you think that mid-teens earnings growth is at risk?
I would say that as of now, there don't seem to be too many risks. Yes, we need to keep an eye on what's going to happen on the crude oil pricing side. Yes, as long as the conflict is very, very localized, then you may not have a big impact on the crude oil prices. But if any of the other countries from the Middle East join the war, then I think there is going to be a bigger issue. And that's where I think crude can move up much higher from current levels. So it's something that we need to remember. And at the same time, we have also seen about a 30% increase in crude oil prices in the last 3 months or so, right? From a low of almost $70 to a barrel, we are at about $90 to a barrel now. So already there has been an increase in crude oil prices, which will flow into margins in terms of adverse impact over the next 1 or 2 quarters with a lag. So there is going to be some impact on the margins anyways that is expected. However, at this point of time, at least for the large cap basket, we don't see too much of earnings risk. Over the next 2 years, we are expecting about 16-17% earnings CAGR, and I think that should happen. And even in the worst case, if there is some disappointment, I think there is not much of a valuation discomfort that is there in that basket. However, if you look at mid and small caps, for example, the earnings CAGR is about 25% for the next 2 years. And also the valuations are at a premium to large cap, as well as the historical mid and small cap average valuations. So to that extent, if at all there is a risk in terms of earnings delivery, that is going to be larger in mid and small caps. So to that extent, we remain slightly cautious on mid and small caps as compared to large caps.
Harsha, on financials, we've seen numbers from HDFC Bank, but I mean, slightly top-down view, and there could be outliers here. The view which seems to be developing is that the best maybe is behind on growth, on asset quality, margins. Maybe it's a different story and will depend on what happened on interest rates. But what's your sense, Harsha?
Prashant, the best may be over in terms of net interest margins, but I don't think the best is over in terms of either the growth or asset quality trends. I think we are at a nascent stage of a new cycle in terms of lending. So to that extent, very unlikely that from a system perspective, there will be too many asset quality issues to contend with. Similarly, the growth seems to be quite strong, both on the retail segment, and also we expect overall corporate lending should also pick up over the next couple of quarters further from these levels. So overall, I think the situation is quite good for banking and financial services. However, as we have already discussed many a times in our interactions earlier, there seems to be some pressure on the net interest margin. So to that extent, yes, when you look at financial year 24 earnings growth for banks in particular, as compared to the previous year, there is a slowdown, but it is still the healthy earnings growth, which is higher than the overall market average. So to that extent, this is not a segment that will probably underperform for a long period of time. Maybe it will not perform as much as what we have seen in financial year 23. That's possible, and that's already visible in terms of the stock performance of the sector. Nevertheless, I think it's not a segment where you can avoid. You need to have a position, and from a medium-term perspective, this is likely to continue outperform.
Okay, by the way, JK Tyres is now up 9% and has hit a fresh 52-week high. That's JK Tyres for you. So the street is definitely building in a lot of positives ahead of these earnings after seeing SIAT's fabulous performance. JK Tyres has now risen almost 85% in 2023. So that's the move there. But Harsha, you said you're bullish on the tyre segment and the auto sector also is doing well. But where do you see the valuation or growth even now in the OEMs? Is it in names like Maruti, M&M? Do you like the commercial vehicle makers like Ashok Leyland? If you can just split it up for us segment-wise.
If you look at the near-term growth trajectory, I think except for tractors, everywhere there seems to be a reasonably a strong volume growth trend. And we have also seen a lot of new models coming and hitting the market. So to that extent, I think the excitement still continues on two-wheelers, passenger vehicles, and also commercial vehicles seem to be doing reasonably okay. So all these segments are expected to show better volume as we go ahead, and margin should also improve. So overall, auto is one basket where you will see significantly higher earnings growth as compared to the market expectation of about mid-teens growth for Nifty. So to that extent, I think while some of these positives have already been discounted in the stock prices, but we do believe that there is more to come, and this should continue to outperform the overall market over the next couple of years.
All right. What about the state elections up ahead? Do you think that's a risk in the near term? Because that could go either which direction. Though for 2024, the street is definitely factoring in that the current government, the BJP ruled government, does continue with their policies and also all that they've already started.
Nigel, it's always very difficult to predict election outcomes. I mean, we struggle to predict where the markets are going to go, and elections are even more difficult in that sense to predict. All I would say is if the valuations are at reasonable levels, when you enter the election phase, then probably the downside volatility will be less, even if there is a disappointment compared to market expectations. But if you enter the election phase with all the positives already having been discounted and valuations at a very, very high level, then even if there is no disappointment, there could be some profit after that. So this is how we would probably see. We don't really take event-based bets in our portfolios, but depending on the overall valuations, we will see whether there needs to be a defensive tilt to our portfolio or not. As far as the current valuations are concerned, we are comfortable with large cap valuations. And as I mentioned earlier as well, a mid and small cap segment is where we have slight nervousness. And it all depends on where we end up before entering the elections on these segments. And depending on those valuations at that point of time, we will probably take a further view.
Okay, Harsha, we'll leave it there. Thank you very much for your time. Great speaking with you. And it's always a pleasure having you here on CNBC TV18. So that's the view coming in from Kotak Asset Management Company. The market is up just under 90 points, 85 points to be precise. Well, let's stay with markets and let's talk about capital market plays. And Angel One is what we are talking about. It routinely now comes up as one of the top ideas when people talk about how to get exposure to this sort of, secular rise in retail market participation that we've seen. It's also seen as a mix between, sort of a consumer tech play. Dinesh Thakkar is chairman and managing director at the company. He's joining us now to talk to us about their performance and, of course, a little more than that as well. Dinesh, great to have you with us here. Good morning, Prashant this side, and thank you very much that you're able to make it on very short notice. So thanks.
Thank you very much. My pleasure.
Dinesh, let's just start with, what did you see in terms of new client addition momentum and also order volume momentum at Angel in the quarter gone by? And how has it continued into the quarter that we are in so far? Go on.
See, last quarter was definitely historic because of many reasons. First, we had shifted from our traditional broking app to super app. So that created lots of kind of traction for new to market customer. And last quarter, we were able to add around 21 lakh new customers. And our total customer base has gone to around 1 crore 70 lakh, which is kind of a lifetime high. Our orders also grew by around, 50% year on year. So last quarter, we were able to clock number of orders were around 34 crores, which is again lifetime high. So what we are seeing is that there is a secular kind of rise in terms of new investors who are new to market and who wants a kind of an easy journey and access to market. That is where I think they are loving this approach of super app. And we are seeing that traction of customer acquisition continuing for even the rest of this kind of period what we are talking about. I feel that lots of people who have been not been given or not gotten proper access to equity market And given the scenario where actually inflation is low and return on equity appears to be higher, corporate earning appears to be higher than inflation, lots of youth are showing interest to come to the market and try to explore possibility of how to make second income and how to create wealth out of this market.
Absolutely. Dinesh, hi, good morning and thanks for joining in. You've also had that early mover advantage, right, in this digital push in catering to the younger audience, especially in tier 2 and tier 3 cities. So kudos to you for that. You were telling us about how it's a 1.7 crore customer base now that you're sitting on, which is a lifetime high. But I want to understand from you whether this run rate that you've seen, the 60% sequential growth in new client additions, is it something that you can continue, or is it just a one-off phase? And what is the kind of average growth that we're looking at in client acquisitions?
See, Sonia, I believe that we are in a market which is very underpenetrated, and especially as you rightly pointed out, when we shifted from traditional to digital, our focus was clear that we will target this set of users, not focus only on traders, but focus on tier 2, tier 3, try to create journey where they are able to have an access to market. So I believe this kind of run rate, what we are seeing, it is because of low base of customer in the industry, I would say. So there is huge opportunity. If you look at people who are having PAN account and all that, it appears to be number is around in the tune of 65 crores. And today, if you look at active customer base, it is hardly to the tune of 3.5, 4 crores. So I think there is lots of opportunity for digital players to grow together.
Hi, Mr. Tucker. Good morning. Nigel on this side. What about your market share? It's slowly been inching up, both in the F&O as well as on the cash average daily turnover. How do you see this number headed? You have gained a couple of percentage points in the last few months.
Yeah. So if you look at new client acquisition, we are at market share of around 22%. And if you look at active customer base, we are yet around a bit less than 15%. So these are lead indicators. If at all you have a good run rate in terms of new acquisition of customer, it takes time to bake the customer in and they understand journey, they understand market. So slowly, gradually, we will see increase in market share. Reason being because we are able to acquire more customer, new customer to the market. So I feel this kind of increase in market share is a bit logical. And if you look at customer addition, until the time we are able to gain market share in new client addition, I think this kind of progression towards acquiring or getting more market share in turnover and all that will continue.
Dinesh, so bulk of the business for you is, of course, still broking as it is for others as well. But, you're trying to build it out, a third-party distribution, etc. Is the super app going to be, since it's already out there, what's the response like? And what will be the share of revenues from that line over a period of time, as you see it? What's the aim, at least?
Yeah. So currently, if you see that most of these revenues for all digital players who are into stock market comes from broking. And this year we introduced Super App. Reason was to introduce more services on our platform. So first what we introduced in April was mutual fund journey. So if you look at incremental SIP number that we have achieved last quarter, on terms of incremental SIPs that we have achieved, we are number 2 now. We achieved around 725,000 new SIP created on our platform. So focus is to be into multi-service area where we are able to fulfill the requirement of customer in terms of their all lifelong requirement for personal finance. So aim is to be a market leader in mutual fund, market leader in lending business, and we would be gradually introducing insurance businesses on our platform. So slowly we are moving towards introducing our own AMC and even wealth management thing. So it would be very difficult to say how this revenue is going to shift, because if you look at broking and all that, they are growing at a very decent rate. So to revenue mix to change, it will take some time.
Yeah. No, absolutely. The core is firing well. But so you're saying that AIMS, you want to go into the AMC business as well?
Yes. So already we have applied for license. We have got in principle approval. And we are in the stage of already we have finalized for final approval. So we are expecting
And this
by this
will be
financial year end.
And do you want to go on the passive side, active side, or will it be a overall offering with both?
No, Prashant, we believe a right product for retail investor is ETFs and all that. So we would be on a passive side. Rest of this conference like mutual fund, we are a distributor for all mutual funds. So we would not like to go on an active side.
And on the lending side, Dinesh, could you tell us your plans? Is it already started, or you will launch it?
Prashant, we are integrating our app with a few manufacturers and trying to fine-tune the journeys. We would be distributor in that area.
Okay.
We would not like to expose our own books for this. So I think by the end of this financial year, we would start lending to our customer base.
Yeah, and just as a kind of a target internally, where would you want all of these broking? What would you like the sort of number to be over? Because that also reduces. The broking business used to be cyclical. Hopefully, it is not anymore with client additions over the last couple of years being absolutely fantastic. But where would you like the non-broking revenues to be as a percentage of the total over a period of time?
See, over a period of time, if I take 5 to 7 years, we would like to see broking remaining in below 50% of our total revenue.
Below 50, okay. And that
below
is...
50.
Okay, all right, got it.
Okay, so broking to be below 50% of your total revenue, got it. You were telling us about various things, and I think this is important even from a shareholder standpoint, right? You're going to be introducing the insurance business on your platforms. You're going to introduce AMC and your own wealth management business as well. You have a new management on board. Ravi Sinha has taken over as the Chief Product and Technology Officer. Can you tell us what is the plan in mind over the next 12 months, apart from what you've spoken about so far, in terms of client acquisition, in terms of growth? What will he be bringing to the table?
Yeah, so he is a new CPTO that we have brought in because we have to work on quite a new architecture so that we are able to put multiple services on this app where not cluttering too much of an app or not making it too crowded. So his main responsibility would be to look at new technologies and bring in new areas where we can increase our efficiency and keep our app simple. So he has lots of experience. He has worked with Flipkart and Yahoo, and he's restructuring the whole thing so that it is aligned to every business needs, because now we are getting into multiple businesses, like we are dividing our broking, one into digital, second into assisted business, where we see big opportunities. So technological approach for both and product approach for both would be very different. And
Absolutely.
plus we are adding mutual fund and wealth management services and trying to build a lending platform on the same platform. So it requires quite a creative thought process in terms of how do we look at our tech stack.
Absolutely, and I think that is the need of the hour, right? To make your digital presence stronger. And I'm glad you're doing that. I'm sure your shareholders would like it as well. Just coming back to the core numbers, in Q2, your cost to net income has improved sequentially. I think right now it is standing at somewhere around 50% plus. Is this something that you can improve upon further over the next couple of quarters?
In every quarterly, I have told that we are not looking at cost efficiency currently. We are looking at spending on technology and improving experience of customer. As we are getting into new verticals, we have to take lots of cost on that side. So revenue from that will come later. It's an upfronted cost that we take. So we like to maintain this margin at 50%. We would not look at cost efficiency at this juncture, where actually we are looking at growth from other businesses.
All right, Dinesh, we'll leave it at that. All the best and congratulations once again on a strong set of numbers and the growth path that you have charted out for yourself. a big beneficiary of the improvement that we've seen in the equity cult as well. Angel One sitting with growth of around 2%. Let's slip into a quick break. On the other side, Dhruv Shringi, who's the Chief Executive Officer at Yatra Online, will be joining in to discuss their Q2 earnings. Later in a special segment, Quarter Se Quarter Tak, we put focus on expectations from the auto sector this quarter. Jay Kale of Elara Capital will join in to give us his expectations. Stay tuned.
Welcome back. Well, the market's holding well in the green, so let's focus on one of the latest debutants on the last trade. Yatra Online, well, in its first results since listing, the company has reported a healthy revenue growth, while the margins have also expanded. The company has signed 19 new corporate clients during the second quarter. To understand more about it, we have Mr. Dhruv Shringi, the Chief Executive Officer at Yatra Online. Hi, Dhruv. Morning. Thanks so much for joining in. Well, give us a couple of details. Quarter one we have. But how is quarter two shaping up? Are you seeing similar traction on, for your business?
Hi, good morning, and thank you for having me on your show. You would have seen that, we posted strong numbers in the last quarter. The secular trend for the travel industry continues to remain quite strong. If you look at the data for the first 9 months of the year as well, domestic aviation has grown almost at 29%. So we continue to see strong growth happening on the aviation front and on the domestic hotel and holiday front. So overall, the macro tailwinds are quite strong, and that continues to bode well for the industry and Yatra in particular.
Okay, all right. Dhruv, in the first half of the year, have you grown at a pace which is faster than your industry? If yes, what is your updated market share?
Sure. So if you look at the industry data, the industry in the first quarter would have grown about 14.8% year over year, and we guys grew almost in the mid-40s. So there's a significantly faster growth rate than the market that we're witnessing at this point. Our market share would now be touching in the range of about, somewhere in the 6.5% to 7% range of the overall aviation market in India.
But I think earlier you had said that you have a 9% market share in value terms, right? So you're saying your market share has fallen?
No. So in customer terms, it would be around the 7% mark. But because we are servicing more the top end of the customers, right? So the larger companies, the big four accounting firms, the big software technology companies. So the spend share would be higher. The spend share, which is the value term number, would be in the range of 9 to 10%.
Okay. So from this 9 to 10% value market share that you have, what is your target, say, over the next 1 year?
See, our expectation is that, if the market is growing at about, early teens, we would ideally want to grow between 1.5 to 2x of market growth. So our expectation is to continue to grow significantly faster than the market.
Okay. 1.5%, 2%. Got that. Can you tell us what is your targeted margins for this year? I think your adjusted EBITDA margin target was at high teens for over the next 3 to 5 years. But in the very near term, by the end of FY24 and 25, what are you looking at?
See, we're already trending in the mid-teens right now, and we continue to see good operating leverage in the business. So my expectation would be that, we would be somewhere in the mid-high teens in the near term before getting into, hopefully the 20% kind of range over the course of the next 3 years.
Dhruv, how does that happen? What's the roadmap or rather the mechanics of increasing margins to 20 and beyond? Because, corporates want to cut costs across the board. Travel and, stay, etc. There's a cost, and you're an intermediary. The only big advantage of the lever you have is offering a lower cost, right? The lowest cost possible.
Which is exactly where we come in, right? And we are helping corporate organizations, especially the large ones, organize their spends. We work closely with them in terms of making sure that, spends are happening within policy. There is no leakage of spend that happens. We will work with them in terms of negotiating better deals for them from the airlines and jointly with the hotels. So we provide a single platform, and it's a complete platform play. Once the platform is integrated within the corporate organization, it becomes easier for us to sell multiple products at a much lower incremental cost. And that's where the operating leverage for us comes in as well. So it's a benefit both for the organization, for our clients, where we are able to deliver value by getting them better pricing and making sure that there is much tighter compliance on the spends. And likewise for us, by cross-selling multiple products and services on the same platform, we're able to drive better operating margins.
When these clients that you said that you added, usually it's only, a corporate would only have sort of Yatra as an intermediary, or would it have multiple? Are these usually exclusive in nature? That is one. And second, how sticky is this? I mean, do sort of corporates shop around as well if they find or is it very sticky? I mean, once you sign on, you kind of stay on for a few years.
Yeah. So in terms of the exclusivity, roughly about 2/3 of our top 100 customers are exclusive with us, and the rest would be shared. In terms of, again, the stickiness, see, once we deploy a technology solution and we integrate tightly within the organization, it continues to remain a highly sticky proposition. 91 out of our top 100 customers have been with us for more than 3 years, and 67 have been with us for more than 5 years. So there is a high amount of stickiness which is there once we end up implementing the solution. And do take into account that we are a fast-growing company at this point, so the numbers will only strengthen as we go forward from a stickiness perspective.
All right, Dhruv, from the money that you all raised, you all had also highlighted that you all could be looking at some M&A. What's the outlook out there? Should we hear about something in this calendar year or in this fiscal year? And what could be the potential size of the acquisition?
Sure. So in terms of M&A, that's obviously something that we've looked at closely in the past as well. We've done a few acquisitions that we've successfully integrated, and we would continue to adopt the same model going forward as well. In terms of timings, I think M&As do tend to be a bit tricky from a timing assessment perspective, but it's something that we are keeping a close eye on and actively evaluating.
Okay, all right. Dhruv, we'll leave it there. Thank you very much. Good luck, and hope to speak with you again soon to get a sense of business, maybe mid-quarter or something. Thank you very much for joining us with that perspective. Let's go across to our next segment, the special segment, Quarter Se Quarter Tak. We sort of train our lens on a particular sector, and today it's autos. Sonia's walked across, and she's going to tell us what to expect from the space. Sonia, over to you.
Well, thanks a lot for that. Let me start with the best part, which is the stock performance, right? Auto stocks have skyrocketed in 2023 with gains of anywhere between 20 to about 60%. Let's take a look at some of them. Tata Motors has been by far the best performer this year with a 62% gain, followed by a lot of the other stocks that have gained anywhere between 40 and 42%. However, it's going to be a mixed bag this time in terms of the sectoral performance. So the volume growth momentum has remained steady for both passenger vehicles as well as commercial vehicles, but volumes are weak for the two-wheelers and tractor sector. The margin improvement, though, has come through because of softening commodity prices and operating leverage. So let's go deep down into the volume growth first up. Now, this quarter, the passenger car segment continues to see a low single-digit growth in volumes. The street is expecting just a 5% growth in passenger cars, and there are definitely signs of demand moderation that are visible. The industry inventory levels remain quite elevated at around 330,000 units. As on September end, the demand for small cars remained very weak, while the waiting period for popular cars are also coming down. So that's a segment that has not been doing well. But looking at the other sectors, the medium and heavy commercial vehicle segment volumes are expected to rise by 18% year-on-year, while two-wheeler volumes are down 2% year-on-year and tractors are down about 3%. So these are two spaces that have not done well, two-wheelers and tractors, as you can see on the screen. Now, the margin expansion is a positive trigger for the company. The EBITDA margins of the auto OEM universe X of JLR will expand for the 6th consecutive quarter on a year-on-year basis. And this is the kind of expansion that we are expecting across the board. The strongest margin expansion will come through for a company like Maruti, followed by, Bajaj Auto, Ashok Leyland, etc. Let's end with the valuation table. And if you look at it, within two-wheelers, TVS Motors now the most expensive stock, trading at almost 30 times forward. That's FY25 PE, while a couple of others like Hero MotoCorp still continue to trade, cheaper than their peers because of not too much of a recovery in the rural market. Let's move on to the passenger vehicle space. Maruti is now trading at 24 times FY25 compared to an M&M trading at 17.5 times. Of course, it's not an apples-to-apples comparison because M&M has a tractor business as well. But let's now take it with the commercial vehicle space, where Ashok Leyland is definitely the stock that is the most expensive at 17 times, while Tata Motors at 11.5 times. There again, not an apples-to-apples comparison because Ashok Leyland is a pure play commercial vehicle player. But Jay Kale, who's the Senior Vice President Research at Elara Capital, joins us now to tell us what to expect. Jay, we just laid the foundation of what the sector could do this quarter, but you tell us which are the companies that could do well, which are the companies that could move to the back burner this time?
Yeah, good morning, Sonia. So, in Q2 FY24, of course, this is one of the quarters where, all the stars are aligning, so to say, that, you've got favorable raw material prices, you've got good volume growth, in anticipation of the festive season. The, volume ramp up has been pretty good in Q2. And at the same time, for various companies, the mix has also been more on the premiumization side. So the premiumization trend has continued as we move up towards the festive season. So, and also, normally the festive discounts that come in, this time festive being in Q3, those will be booked in Q3 and not in Q2. So Q2 is, probably one of the better quarters, where we will have a benefit of volumes as well as margins. And, like you mentioned, Maruti specifically seems to have a pretty good QOQ margin expansion led by premiumization and volume growth. And then, of course, two-wheelers, again, there will be some of them which will have a favorable mix, adverse mix. But I think Bajaj Auto within that seems to be pretty well placed. Same with Hero MotoCorp and TVS. Eicher, there is some bit of impact of adverse mix. So I think all in all, a pretty good quarter. And I think all eyes will now be on the festive season because how Q3 and Q4 volumes shape up will be a function of how the festive season pans out.
All right. I wanted your thoughts also on what's happening in the tyre space because that news is immediate, right? I mean, you've had a very good performance from CEAT and now all the other tyre stocks are running up. But how are the valuations looking for the sector now? Which is the stock that has more valuation upside?
I think, tyres, last few quarters, they have continued to surprise on the margin side. I think Q2 also, with CEAT reporting a QOQ margin expansion. Given that it has also come by gross margin expansion, one would have a positive read-through for Apollo and MRF as well. And that's why we're seeing most of the tyre stocks on the upward trend. But, one has to be careful in terms of how the margin trajectory moves. Tyre sector has been very volatile in terms of margins. With recent increase in crude and, natural rubber prices, you could see some softening of margins in Q3 and Q4. But for the moment, I think the going is quite good for the tyre space.
Okay, the going is good for the tyre space. Where else are you seeing traction? Now, two-wheelers is interesting, right? Because the volumes year-on-year have still fallen. But the managements are very hopeful that exports are picking up in a big way. And towards the fag end of the quarter, you've seen an improvement. And on a valuation parameter, something like a Hero MotoCorp is still cheaply valued compared to its peers. Would that be your stock of choice, or do you like any others in the two-wheeler space?
In the two-wheeler space, we are positive on Bajaj, TVS and Hero, and we have a negative bias towards Eicher. That's how we position our view on the two-wheeler space. Again, festive season is extremely important for the two-wheeler space, given that the 32-day festive season probably retails close to 2 months of a normal month retail. So that's the weightage of this festive season. And based on that, you will see how 2H volumes pan out. But on the export side, I think we are seeing at least the bottoming out. And now the low base has kicked in, and hence players like Bajaj and TVS will favor well. Whereas for Hero, I think it is mainly on the festive. All hopes are hinged on the festive season.
Okay. And in the commercial vehicle space, what's the expectation this time between Ashok Leyland and Tata Motors? Of course, Ashok Leyland is the more expensive stock. But what are you looking at in terms of numbers, and are these valuations justified?
I think commercial vehicles, and especially MN and CV, if you see our expectation for FY24 in terms of growth rate is 10%. Now, to get that, you will see Q3 expectation is a strong double-digit growth. whereas Q4 will be muted given the last year's high base as well as a pre-election. There is some bit of softening in terms of the fund flow that happens in this space. So I think full year growth, I think 10% growth still remains intact. Tata Motors, frankly, is not, like you mentioned earlier, also is not really a pure play commercial vehicle. A lot depends on how JLR pans out as well. But on Ashok Leyland specifically, I think what has been encouraging is that the discounts have been fairly under check. Of course, they have increased from a quarter-on-quarter basis and all. But as a trend, if I have to see, they have been under check. So that should bode well for margins for Ashok Leyland as well, as what the case is for the entire auto space.
Okay, all right. Just one final question, because tomorrow you have Bajaj Auto's numbers. You mentioned it briefly, but the stock has already rallied 40% this year. Numbers are expected to be decent this time. What are your own expectations and what are the things that one needs to watch out for? And do you see a further upside in the stock?
Yes, I think, the key things to watch out would be the commentary on the festive season and the commentary in the export markets. I think these two are the main drivers. And of course, their ramp up on the Triumph side. But one good thing is that the mix of Bajaj Auto continues to improve, and we've historically seen that their delivery on margins have been pretty good. They have been consistent in terms of margin performance, lesser volatile than many other players. But I think the key thing to be watch out for is the domestic festive season and the exports commentary, as well as the three-wheeler. I think they have been doing pretty well in the last 1 or 2 months specifically. So we have a buy rating on Bajaj Auto, and we have a target price closer to 6,000.
Okay, all right, Jay. Thanks so much for stopping by and filling us in with your take on all of those auto stocks. We look forward to those numbers. By the way, the first 45 minutes of trade actually been quite good for the bulls, because you have the Nifty that's still holding with a gain of close to around 100 points. The intraday dip is getting bought into, and a few notable stocks that are doing well. HDFC Bank actually is not the big outperformer. ICICI Bank has done quite well. HDFC Life as well has perked up, and Bharti Airtel, that stock as well, it's a larger weight in there, that as well has moved a little bit higher in the last few minutes. And as we're having the chat with Jay, we have Maruti as well that's spiked up. Midesh Thakkar is back with us. Midesh, what's your view? I mean, it's looking quite good. The Nifty Bank, though, it's unable to get past that 44,600, 44,700 odd. So how do you view the indices and your fresh call?
I think the Bank Nifty is now closer to about 19,850. The Nifty is closer to about 19,850, which is, for me, an important pivot. Now, let's see if we get a closing around 11 o'clock above this level, and then maybe we'll explore some long. The Bank Nifty, while it's been underperforming, moved beyond 44,700, and we are still away from that. I think would add to some momentum. So I think till that happens, I would not bet on the Bank Nifty. I would still focus on the Nifty. And on the stock side, I think what could possibly prop up things could be Tata Power, which is now on the verge of getting into a positive mode after about 2 weeks of correction. So I would recommend buying here with a stop at 253 for a target of 270. And the other one which I like is Steel Authority, which is reversing after a long correction. That's a buy as well. Keep a stop below 88.5 and a target of 95 can be looked at.
Oh.
You've got some of these railway names, right? IRFC is popping up 4%. I think Ircon is up about 6%. Railtel is up about 6%. These were not there in the morning, but they are there with decent gains, 4, 5, 6% across the board. And when you see these moves, it's usually the sector which is higher. Just a couple other names. Look, Senco Gold is up another 4.5%, 691 on Senco Gold. Newer names, Metro Brands is up about 4.5%. Iron Exchange, that was up sharply yesterday. I think almost doubled in double digits. It's up another 5% this morning. That's Iron Exchange. Data Patterns is up 6%. And there is VATech Vabag. I mean, actually, the same water purification theme, Iron Exchange and VATech Vabag. VATech is also up about 7.5% at this point in time. So, yeah, there is a fair bit happening. Also, look at these government companies with little free float. Look at ITDC. It's up. ITDC saw a sharp move yesterday. It's up again today. STC India, that is State Trading Corporation, that's up 11%. Not ITD Cementation, but the other one. That's ITDC is what I'm talking about. And the other one is, MMTC, which is, again, small free float, which is up about 5.5%. And I already mentioned STC India. So, yeah, I mean, a lot happening in the broader markets right now. 100 points is what we have on the Nifty at this stage. We'll take a quick commercial break here. We'll come back. We'll shift our focus to the commodity markets. Manisha Gupta will be with us to run us through what she's tracking. Stay tuned. We're back.
Well, big moves in the market, 100 points higher on the Nifty and holding on to its gains. A lot of big, movers in the broader end. Chennai Petro is now up almost about 12%. Of course, tire stocks are doing very well. And then something like a Metro Brands, Latent View, all up and about today. But let's shift focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking this morning?
Well, I'm looking at the metal as a sector which has seen profit taking for a second straight day today in the markets there. Well, we are looking at prices slip also ahead of the China third quarter GDP numbers that come in today, and the markets are jittery ahead of that as well. The expectation, though, clearly that you could be looking at weaker numbers coming in out of that country there. China also has avoided the rate cut as we saw those numbers come in yesterday, and the weaker yuan continues to weigh on many of these commodity markets within China itself. Also, the government-led infrastructure, especially in case of renewables, has led to demand come back in case of metals. But as far as automobiles or real estate as a sector go, we have seen weaker demand in China continue there. I'll talk about some metals here, and copper prices for one is trading at near 5-month lows. In the Indian markets on MCX, we've seen the prices decline below 700 rupees a kg as well. If you look at LME and Shanghai, we've seen inventories continue to gain onto this one. Also, supply, as according to EIA and International Copper Association, is expected to increase by 26%, but that is by 2035. They also say that the demand will, though, increase by 50% during the same period. So when you look at the longer period for copper, as in sense of demand and prices, is expected to be much on the higher side. But at this point in time, there is weaker demand, higher supplies, higher production, and that continues to weigh onto the market there. That's about nickel now, where we have seen prices trade at a 2-year lows. That is because the EV battery prices have declined by 10% in the month of August. The inventories have been on the higher side. Demand has slipped, and that's weighing in case of nickel as well. Also, when you look at the steel prices, they have been on the weaker side. That's weighing onto this one. If you look at the inventories, they are the highest in last 10 years, and the prices have continued to decline on back of that. Aluminum for other metal also has seen decline below $2,200 a ton there. We have seen prices decline by nearly 4.5% in matter of last 1 month. And that is a chart that will show you that. If you look at week-on-week basis, only iron ore and steel in some sense are trading in the positive. Rest all the metals are trading in the negative for week-on-week and in month-on-month basis as well. The best gains clearly coming in for the iron ore prices in last 1 week, up by 4.5%, and that is because the inventories have declined for a 5th straight week. We are looking at lower onshore and offshore inventories in case of China there. Also, when you look at the inventories, they are the lowest since June 2020. So iron ore perhaps is your best performer in last 1 week. Every other metal trading in the negative.
Okay, all right. Thanks a lot for that, Manisha. Well, let's hop across to Surbhi. She's joining in to tell us about Cyan DLM as well as ICICI Securities. Surbhi?
Thanks so much for that. So Cyan DLM, it was a mixed bag. It was a very strong revenue growth of over 70% on a year-on-year basis. But the gross margins and the EBITDA margins were under pressure. Gross margins were down 500 basis points due to higher cost of materials that impacted the EBITDA as well. It was flat on a year-on-year basis. EBITDA margins were down 500 basis points. The company also said that they have gotten revenue from the lower margin products, and which has impacted the margins as well. The order book was down 10% on a year-on-year basis, but the brokerages seem to be positive on the overall EMS space, and specifically Cyan DLM. INCRED has an ad rating with a target price of 880. They say a healthy 140 PAT growth is likely going ahead, and the ongoing Israel war is to be monitored. For Motilal Oswal, they have a buy rating with a target price of 870. They expect the company to sustain its growth momentum on the back of strong order book coupled with healthy order inflows, high customer stickiness, and also a strong promoter heritage. They are valuing it at 35 times FY26 PE. For ICICI Securities, it was a strong set of numbers. The revenues were up 34% sequentially. The PAT was up 56% sequentially. And the cost to income ratio was also came in at 44% versus 45% in the previous quarter. Now, most of the revenue growth has come in from the broking and the distribution business, where the growth was 32%. The treasury business, the revenue growth was in single digits. And the issuer and advisory segment, which is the investment banking segment, there the revenue growth was 120%, but it contributes very little to their overall revenues.
All right, thanks a lot for that. Well, Vivek is also joining in. He has KEC and NLC on his radar. Vivek, over to you.
Well, that's right. Both stocks are above, on the back of news flow. First, we have on our radar KEC, some more order wins coming in. The company has seen a slew of order wins, over the Q2 as well as, has begun Q3 on a strong note. Overall, the company has secured new orders of over 1,300 crores. Now, this is across various business segments that the company operates in. That is both the T&D segment as well as the cable segment. And this T&D segment, the company has got orders from multiple geographies as well. So, India, Middle East, Australia, as well as Americas is where the company has got these order wins from. On the other hand, NLC India, very interesting development. Now, what the company has done is the company has incorporated a wholly owned subsidiary called NLC India Green Energy. Now, this particular company will now start implementing close to 2 gigawatts of renewable energy products, and the total target that is envisaged is close to 5 gigawatts of projects, and this is going to be done by 2030. Now, remember also what the company will do is this particular company will participate as well as execute all of the upcoming renewable energy tenders. So NLC clearly carving out a niche space for itself as far as the renewable energy space is concerned.
Okay, all right. Vivek, thanks a lot for that. Well, Dalmia Bharat, yesterday in the final hour of trade, actually, last 2 hours of trade, it was an outperformer. Now, in fact, it's giving back some part of that. So let's run you through the con call details first. They're talking about pricing growth of around 30 to 40 rupees. That's in East India, as well as in South India, around 30 rupees. And that's been absorbed. So that's good. They're saying that the volume growth is likely to rebound from the fourth quarter. So the next quarter should be a little bit tepid, as it's been in the second quarter as well. They have lagged industry growth. And the other factor they talk about is JPA acquisition. That's the JP Assets acquisition is likely to be finished by the end of this fiscal. And they've also said the capex for this year, they have highlighted around 6,500 crores. 3,500 crores out of that will be for the JPA asset. What are brokerages saying? Well, we have a split verdict between Nomura as well as Jefferies. Nomura, they have downgraded the stock to neutral. They say that, in fact, the company is lagging in the race for market share. And they expect it to continue to lag from year on as well with regard to industry growth. They're also saying that there's no big clarity on the JPA acquisition, and they are factoring in that this gets closed out in the first half of next fiscal. Remember, the management is talking about closing it out in this fiscal itself. They also go to say that profitability from year on will be driven by realizations because bulk of the cost savings are already done by them. Jefferies, though, they retain a buy rating. They've gone ahead and increased their target price to around 2,680 rupees. They expect the second half of the year to be much better on hopes of price hikes sustaining. So a split verdict out there, but for the time being, Nomura has got the upper hand.
All right, Nigel, thanks very much for that. Well, 90 points is what we have on the Nifty. Let's just look at the Maruti stock. The pref issue announcement, it came on the exchanges and we put that out. I think we've seen a bit of a sell-off on the stock. There you go. I mean, it's seen a dip, but it's getting bought back now. Almost down 1.25%, but now just about a 0.5% loss. We'll take a quick commercial break here. We'll come back and we'll have Jayant Dasgupta, former ambassador, World Trade Organization, and Vinod Giri, Confederation of Indian Alcoholic Beverages Companies, joining us to talk about how the potential India-UK free trade agreement will impact that particular sector. And we'll have more on that coming up in just a bit. Welcome back. 90 points on the Nifty. 19,822 is where we are at. The India-UK FTA is expected to happen this time around. The expectation is that we will soon see something by the end of the month getting signed. There are also reports which say that India perhaps will have limited benefits as many exports to UK already enjoy low or zero tariffs. Let's actually discuss this in some detail. Jayant Dasgupta is former ambassador of India to the World Trade Organization. Vinod Giri is Director General, Confederation of Indian Alcoholic Beverage Companies. Gentlemen, great to have both of you here. Thank you very much for your time. Ambassador Dasgupta, if I can start with you, sir. First of all, if you've been tracking this closely, do you think we will get this done this time around? Because there were some thorny, contentious issues. The last time around, this came close to fruition as well. If you've looked at the relationship between India and UK, trade relations between India and UK closely, do you believe that benefits to Indian companies are going to be limited as is being speculated? Or you think this can be a meaningful booster if the FTA indeed is signed?
You've raised a lot of very important issues. The first one is about concluding the FTA negotiations this time around. And I think the chances are very bright indeed, because out of 26 chapters, in more than 20, I think the negotiations have been concluded. So there are only a few niggling issues left. And of course, there are these 2-3 major things which have to be tied up, which are basically about the movement of skilled professionals, for which India has been making certain demands. On the other side is about the alcoholic beverages segment, which I'm sure my fellow panelists will have more to speak on. And the third one is about cars, automobiles, and a few other items in which the UK is greatly interested. The last issue is about financial services, in which the UK is asking for greater access, and of course the investment treaty.
Sorry,
the UK, yes.
So 20 out of 26 there is agreement. But is it possible, in terms of how these things usually happen, if they can't agree on everything, could it be a limited kind of an FTA, leaving some of these issues out, or usually it is all or nothing?
Right at the beginning or midway through the negotiations, I think that is the right time to decide whether it would be a limited scope FTA and the rest of the chapters will get concluded at another juncture. But in this case, it has been decided that everything should be negotiated together and it should be a comprehensive agreement. So I think the chances are very bright that we will see a conclusion of the FTA within this year. As far as the benefits are concerned, if you look at merchandise trade, India exported about $11 billion worth of products to the UK last year. And of that, $6 billion, petroleum products, diamonds, machinery items, aeroplanes, wooden furniture, etc., they already enjoy zero duty access to the UK. And about $5 billion worth, which are apparel, leather items, etc., they have certain duties. For yarn and fabrics, it is just 4%. But for finished products in textiles like clothing items, it ranges between 10 and 12%. So with the conclusion of this FTA, hopefully we will get zero duty access for all textile products spanning from yarn to finished clothing items. And so for leather items as well, carpets, etc. So it should provide benefits in that segment for about $5 billion.
Got it. So you're saying that the textile sector, the leather sector are sectors that would be big beneficiaries of it. So just to understand, a lot of the non-traditional sectors, whether it's petroleum products, diamonds, machinery, pharma, that have been big exporters in the recent years, they're already enjoying zero duty, right? So by and large, apart from the sectors that you mentioned, which is textiles and to some degree, maybe even leather, there's not much of a positive impact. Is that the right way to read it?
In the case of merchandise goods, there would be benefits, but it would not be across the board because, as I mentioned, more than 50% of the products trade is already enjoying zero duty access to UK. But for the rest of the products, like labor-intensive products like textiles, leather, carpet, etc., we will gain.
Okay, let me get Mr. Vinod Giri in as well. Mr. Giri, on the alcoholic beverages side, what is the situation as of now in terms of what are the terms of trade between India and UK? If you can explain the context and then tell us what would an FTA mean?
So the domestic industry generally has been in support of the FTA from the beginning.
There are basically three expectations that we have. First of all, it should create a level playing field. Number two, there should not be opportunities or windows for misuse of the FTA concessions. And third is that it should be both ways. It should be a two-way street. So that's why, for the first, we recommended a duty reduction from 150% to 100% now, and then bring it down over 10 years' time to about 50%. Secondly, that's why we say 50%, because that's a kind of difference in the cost of production.
Yeah.
We have
Mr. Giri, sorry. Mr. Giri, if you can first tell us what are the duties as of now? And,
so as of now,
are we big exporters? Are we big importers? I'm assuming we're big importers, right? But yeah, go on.
We are massive importers. We hardly export anything to Europe.
Correct.
First of all, the balance of trade is, some say, 95%, 5%, or even more than that.
Okay.
Between UK
and what are the duties right now?
So we have 150% is a flat duty across total duty, which is customs duty as well as the AI duty, across all alcoholic beverages coming in. So that's our starting point. And plus, we have all the duties in the states, which are different matter altogether, which are very high, of course. So this we have suggested to bring it down from 150% to 100% immediately, and thereafter over 10 years' time to 50%, so that we have 5% reduction every year. 50%, we say there should be the resting rate after 10 years, because as we see today, the difference in the cost of production between UK and India is about that much.
Yeah,
So
Mr. Giri, when you said a two-way street, right, we don't export very much. What is the level playing field then?
Yeah, so here is the big catch is there. Currently, the British laws prohibit, or they define whiskey as a spirit which is matured minimum for 3 years' time. Now, we have two problems with that. First of all, it of course pushes up the cost significantly, because in India, we have something called angel share, which is the evaporation loss when the whiskey is being matured. Now, that is, in India, is about 10 to 15% every year because of the climatic conditions. Whereas in Scotland, it would be 1 to 5%, 1 to 2%. So now we have a situation that 30-35% of the whiskey, if you force that condition, will evaporate. In addition to that, the inventory carrying cost in India, the cost of capital in India is 8 to 10% easily for any company. So you're looking at another cost pile-up happening. Why we think it's superfluous? Because there's enough medical evidence or scientific evidence that the same effect that you achieve in Scotland in 3 years' time can be achieved in India is 9 to 12 months' time. Because of the climatic conditions, we are much warmer. So much warmer climate. So now we have a situation that most of our mainstream products are unable to go to the UK markets because of that condition. It will not be accepted as whiskey. So that severely limits our ability to export. And till the time this matter is addressed, and this is one of our major demands.
Yeah, so 3 years be brought down to what?
So we say, ideally, there should be nothing. Countries like US and all have no such law. Most of the world has no such laws. As long as there is no misleading declaration on the label. But in case if they wish, it can be 1 year's time, because that will be the parity. But most of the world does not have any such law. It's only the Commonwealth countries. Basically, it's UK, Canada, Australia, New Zealand. They have this law.
Got it. And that's the major big demand, right? To basically, which allows access to the UK market for you to be able to export.
Yeah. In absence of that, I'm afraid that Indian industry will not have much to benefit out of this.
Got it, sir. We are out of time, but we could have probably touched upon a few other topics. But this is something which we will come back to, I'm sure, as we kind of go into the end of the month, and hopefully that FTA is sort of agreed upon, and some of these points are also taken up. Thank you very much, Ambassador Dasgupta, Mr. Giri. Appreciate you, both of you, joining in, and hope to have you back again as we continue to track this one. We'll take a quick commercial break. We are up 85 points right now. 19,816 is where the index is at. It's a very, very steady looking screen. 3:1 in terms of advances to decline, so nothing to really complain. It's a wrap on this edition of Bazaar. Chartbusters will take up all the action in just a bit from now.